Singapore's non-oil domestic exports defied all odds in November, racking up their biggest increase in nearly a decade. But analysts say the pace of growth is expected to slow down going into the new year. And that's because the emergence of the Omicron variant has once again brought about some uncertainty.
Growth of non-oil domestic exports, or NODX, picked up pace last month, up from October. It expanded by slightly over 24% on year, soundly beating the 15.3% estimate in a Bloomberg poll. On month, NODX recorded a slower growth of 1.1% in November. The overall swelling of NODX is thanks to significant growth in electronics and non-electronics exports. Shipments of electronic products hiked nearly 30% on year, mainly helped by integrated circuits, computers and disk media exports. Now, one analyst attributes this to a strong demand for consumer products and an accelerated digitalization of companies over the past year.
We see, especially from the chip side, chip is always the number one NODX item, or the number two behind pharma sometimes, but suddenly for November it was solidly the single largest NODX item, I think accounting for over 13% of total NODX.
Meanwhile, non-electronics exports went up by almost 23%, led by specialized machinery, petrochemicals and primary chemicals. Overall, shipments to markets like South Korea, China and Taiwan contributed the most to the growth.
I think have to do a lot with our Singapore being part of this electronics or semiconductor supply chain. So when there is a strong demand, the major semiconductor producers in Taiwan, in South Korea, will increase their production quite a bit. As a result, the shipments from Singapore to these destinations have benefited quite a bit.
But as countries tighten border measures in response to the Omicron variant, analysts expect prices of goods to remain elevated, which could hurt demand.
With supply disruption still a key concern, restrictions still a key worry, because access to labor in an environment where demand is growing is going to be critical, because if you don't have the labor, don't have the material, you cannot meet the orders, for instance, and all the costs will climb.
This, in turn, will discourage people from spending. Looking ahead, analysts also anticipate that the rising costs could drive central banks to tighten their monetary policies.